Yeah, you see me, I am jamming out. It's September. Finally have a little sunshine. It's that crisp fall air out there. It also is 10:46. I'm Guy Adami, joined as always by my dear friend Dan Nathan. Today's episode is brought to you by our presenting sponsors, FactSet, financial data and analytics powered by Tamar, and of course our friends at OpenExchange, because Dan, they manage virtual meetings that matter for the top companies around the world. We're going to hit a couple macro calls, one specifically, single stock research calls, and we got John Butters is back. Oh my God. I don't know how we're going to do it in 14 minutes, but we're going to try. How are you, Dan?
Yeah, we're not going to do it in 14 minutes. We almost got rained out here at 10:46, guys. So I really, I'm impressed with your perseverance to make it. There's a lot going on. I mean, you think the summer doldrums were, they were good for the markets, right? I mean, the markets kept on just chugging along here. But what is September going to bring us, Guy?
Well, we're going to find out. And, it's like, listen, I don't know if you're a fan of the group Blackfoot. I mean, one of the great harmonicas of all time was in a song called Train, Train. Maybe we'll play that later on our Twitter.
Maybe
I don't know. But,
yeah.
And to speak about Aerosmith, the train kept a rolling all night long. That has other meanings. But let's get right into it here in terms of the first thing, because I love Twitter when people go after each other on Twitter. And John Paulson, who I'm sure a lot of you folks know, he basically shorted subprime. He was spot on. He called crypto and I'm quoting now, a worthless bubble. Says gold's about to surge. And all of a sudden, Mike Novogratz, love Novo. I've got the other side of that bet on Twitter. Is that called like adding somebody, Dan? Because it was fantastic.
Yeah, that is it was a subtweet. It was an ad. It was everything all wrapped up in one. Listen, you have to listen to what Paulson has to say, because he did call that subprime. He also called a big rally in gold. This was during the financial crisis here. But again, here's a guy that we haven't really heard of in 10 years. I have no idea what he did. And I suspect he probably had a couple very bad years in the wake of that subprime call, losing the most money off of peak assets. So who really cares, I guess, what some old boomer has to say, Guy Adami, about the crypto?
I hope they care, because I happen to be an old boomer. I guess by definition, if you're a boomer, you're old. But please continue.
No, but listen, Novo getting in there. We had him on our podcast last week, talking about this. For him was the trade of the century, right? So one man's worthless bubble is another man's fortune here, I guess. And, Novo's built a whole business, Galaxy Digital, around the crypto space. They are a merchant bank. He obviously sees something that Paulson doesn't. Let's just take a look at the chart. Guy, Bitcoin is nearing $1 trillion again. It's kind of flirting with that $50,000 level, a nice round number here. We know it topped out in the spring at 64.5. A lot of excitement around crypto right now. A lot of things that people think are bubblicious. You think non-fungible tokens and the hundreds of millions of dollars that are trading in them, but they're trading largely on other blockchains, on Ethereum and on Solana.
It's very hard to say it's a worthless bubble when, to your point, Dan, I guess at its zenith, the entire of crypto was a market cap of about $2.3 trillion. Yeah. That was obviously back when Bitcoin itself was trading around 64. But to your point, it's very hard to say it's a worthless bubble when you have market capitalization of that magnitude. And by the way, a lot of people think it's going significantly higher than there. And if you look at this chart, I wish it had traded down to that $21,000, $22,000 level. That prior support, it didn't, but that's a healthy looking chart. And one has to say, you know what, as fall approaches, maybe Bitcoin makes a run at that 64,000. So worthless, we'll see. A lot of people believe that. There are a lot of people like Mike Novogratz that think it goes significantly higher. And again, it's hard to say it's a worthless bubble when you have market capitalization of that magnitude, Dan, which leads us to our next chart, in sort of the slided Earl scenario. Talk to me about this, Dan Nathan, because this is, in fact, gold. We're in this downtrend. You've been spot on. I thought we'd surely be higher than last August high. Yeah. But here we are sort of meandering, and that's the word I'm choosing to use, meandering.
Yeah, so that Bitcoin chart was a one-year chart, and it shows obviously a great deal of volatility, but it also shows it coming off the mat from the lows in 2020. Okay, it was left for dead. The stock market went down 35% in February and March of 2020, and Bitcoin went down like 60% or something. So people were throwing it out. People did think it was worthless. I think it got as low as 3,500. On the flip side of that, gold started to work, and it started to work in a big way here. But at some point, over the last, let's say, year, really since the August highs in gold. I mean, people have just said, listen, if gold has global reserves of what, 12, 13 trillion, and Bitcoin was a half a trillion, and I think it's more durable gold. Hey, you tell me, what's gold worth? Do you wear a gold watch? Do you use it in industrial processes? Is it just a greater fool's theory that it's some form of inflation hedge? I don't know. If that's all you believe, then I'd rather own digital gold, I suspect.
Yeah, no, it's fair. But I will tell you, just to counter that real quick, central banks have been buying gold in record amounts over the last 6 months. Number one. And net Palantir, I know you're going to say $50 million is nothing. You're right. In the context of their market cap, $50 million is a drop in the bucket. But I found it interesting that Palantir announcement a few weeks ago that they bought $50.9 million worth of actual gold bars, just something to store away. They obviously see something, and they are some smart folks there. The next chart we got to look at, though, is what appears to be sort of the Mount Everest. And we're sort of at that in the death zone for those climbers out there. But this is the S&P 500, which has just been basically straight up now for quite some time. It's remarkable how impervious the S&P has been to a myriad of bad news headlines. Doesn't seem to matter, Nathan.
Yeah, so to your point, Guy, it's getting a little steep here, this uptrend, and sooner or later we're going to have, some form of sell-off. We've only had one 5% peak to trough decline. I think going back to 1980, the S&P 500 has averaged, you might have quoted this last week, 4.5 5% peak to trough declines. Mm-hmm. We have not had more than one at this point here. That's coming to a theater near you. I don't know when that happens here. I'll just mention this, Guy. I mean, at a certain point, there's got to be more, and we're going to hit this with John Butters and some of his data at the end. I think the S&P has doubled from its lows in March 2020. I think David Rosenberg Research wrote this the other day in one of his reports that 75% of the gain is multiple expansion, while 25% is predicated on earnings growth. And when you think about that, what's important looking back is that usually it's about 55-45, that sort of thing. So we're just kind of getting these expanding multiples. Maybe that has something to do with rates and the belief that people don't think they're going too high anytime soon. What's your take there?
Well, you better hope that 75%, goes quickly down to 50%, and then somehow we get the back end of actual earnings growth, and then this market can continue. I would submit that multiple expansion. I mean, that's great if you're going to have that earnings growth on the back end. I just don't see it happening. And I think a lot of this is predicated on, the fact that the market believes that the Fed has our back and there's a lot of liquidity out there. But, we traded down the 50-day moving average in the S&P 500. We bounced off it like a champ. Now it's probably a month and a half, 2 months ago. That 200-day moving average probably comes in just north of 4,000. We'll see. My views on this thing. I think the market's far too complacent. And by the way, the next chart sort of speaks to that. The VIX is sort of in no man's land, in my opinion. We've had these little rallies in the VIX. They last literally 24 to 36 hours, and then the VIX is headed right back down. Well, here we are right now, sort of sub 16. I think the market's way too complacent, whistling past the graveyard, as they say, and that's manifesting itself in a VIX. It just does not want to go up and stay up.
Yeah, I read a Bloomberg story yesterday, Guy, talking about how demand for upside calls has kind of subsided off some pretty high levels over the last, let's say, 3 to 6 months. And maybe you're starting to see institutions hedged up a little bit, which could cause one of the reasons that we're talking about here, where, the S&P just kind of ticks higher a little bit every single day. People are feeling confident they have protection on, and you're not seeing exuberant behavior right now in the options market as it relates to upside calls. You are seeing exuberant behavior in other pockets of risk assets. We just talked about the move in crypto and the move into NFTs, and we'll see at some point if they're correlated the way that crypto was correlated to the downside when equities led in Q1 2020. But we got to go to this NDX chart, the Nasdaq 100, Guy. You and I talk about it all the time here on At 1046. Those top 5 names, the Microsoft, Apple, Google, Amazon, and Facebook, make up 45% of the weight, nearly $10 trillion in market cap. Just do the math there. the lowest number of names in the NDX above its 50-day moving average since last September 2020. Last September 2020, the NDX went down about 14% in a straight line. Look at that resistance level. You draw it to those March highs. What happened in March? We broke that 50-day and went down 12%. Okay, so here we are. We bounced off the 50-day just a couple weeks ago. We're up like 5-6% in a straight line. You see the 200-day all the way down there at 13,660 or something like that. What's your take on this? It can't continue to go like this, can it?
I think, well, it's interesting. I think that Nasdaq, these names specifically, got very comfortable with 10-year yields vacillating between sort of 1.2%, 1.35%. And here we are sort of right in the middle of that range. And I think the market sort of figured it out in terms of what yields mean. That's number one. Number two, passive investing, the money flows into the names you just mentioned in a meaningful way. You saw it month end in August. You're seeing it at the start of this month here in September. But as Carter Worth would say, to the penny, we've touched that top of the trend line. You're right. We did bounce off the 50-day, I want to say a month and a half or so ago. But that 200-day moving average, which we haven't seen in quite some time, sort of sticks out like a sore thumb to me. We would still be in a significant uptrend, even if we traded down to that 200-day. And I think it's pretty much a foregone conclusion. And look, maybe we see it in the wake of or in the midst of earnings that we're going to see. It's amazing. We're going to have Facebook earnings coming up, which I think brings us to our first call, Dan Nathan, which we have to take a look at. This Rosenblatt downgraded Facebook. Now, this is a really interesting call. And if you watch Fast Money, you'll know that I've said for quite some time, Facebook to me is a math problem. You put a 25 multiple on the $16 they're going to earn, you have a $400 stock. Well, guess what? That's their price target. So although they downgrade it, they do see some upside. The average analyst price target comes in around 425 or so. I think Facebook is due to report, I'm looking at my notes, early November, which is going to be here before you know it. And that's why I mentioned it. Maybe that's what's going to derail this thing. I think Facebook can continue to rally to that $400 level. But I do like this call. I think it's thoughtful. Dan, thoughts?
Yeah, some of these growth names that have kind of hit the skids a little bit over the last 6 to 9 months or so, they've usually done so because you're dealing with decelerating metrics. They benefited really well during the pandemic, right? You had unexpected growth, and now they're decelerating, but the valuations are high. That's not the case, to your point, Guy. When you have an S&P trading 21, 22, 23 times, and you have a company that's growing, expected to grow sales, right, at 20% a year from here on out, trading at that market multiple, it's just not that expensive, right? So the question is, what is a fundamental shift that could happen in their business? And, they talk about Snap and TikTok and some of these other platforms that are going to be taking a piece of the pie. The problem is the pie keeps growing here, right? Sooner or later, you're going to have a pullback. I look at this chart and you look at the sort of parabolic move since it broke out just above $300. It was in a long consolidation. You have that really nice uptrend from the March lows. It happens to map to the 200-day moving average. You tell me, what is the scenario where the stock trades back down to 300, the 200-day? It would have to be a broad market sell-off. And I'm just going to go back to that NDX chart, Guy. Last September, when the NDX sold off 13-14%, well, Apple and Microsoft and Amazon, they all outperformed to the downside. So some of these big winners have the potential to do that because they are very crowded and they are liquid.
The existential risk to Facebook, if you're asking me, which you clearly are, is not so much people fleeing the platform, which we've seen does not happen. It's not advertisers fleeing the platform, which we saw lasted for about a month, a couple of years ago, and then they're back in spades. The existential risk here is they fall under the auspices or under the magnifying glass of ESG investing. And maybe with some of the disinformation out there now on Facebook in terms of the vaccine and COVID and those things, maybe somehow Facebook will find itself under the thumb of ESG. That, to me, has been and will continue to be the existential risk. So do I think this continues to rally in earnings? Absolutely. I think $400 to me is a foregone conclusion. But we're starting to get into nosebleed territory, and I do like the call, albeit, they're not pounding the table in terms of where they can see the stock. But I think $400 we get to, and we'll see what happens if and when we do get there, Dan. But that trend line you drew on the downside, I think that's absolutely in the crosshairs, and I think we could see it as we reach earnings in early November, Dan Nathan.
Well, there you go. Usually, Guy, you're getting all geeked up at this point. It's the top of the hour, man. It's 11
Oh, wait,
o'clock.
Did I miss it? Oh, my God. It is. I'm sorry. I'm going to hear the bell in a second. We're not even to our second call. Apologies. If you have an 11 o'clock appointment, stick with us. they'll still be there on the back end. Costco, we've talked about this stock on Fast Money seemingly for the last few years. People have talked about it negatively in terms of valuation, and you can understand it is an expensive stock. But Jeffrey just raised their price target to $525, makes it the highest price target on Wall Street. I'm looking at my notes. They report on September 23rd. We're going to look at a chart in a second. This has been a huge winner, but if you like Costco, it's its valuation. My sense is you got to love Walmart at their valuation. Basically trades at half the multiple. And obviously, they don't have nearly the growth that Costco has. Thoughts on this? Because I actually do like this call into earnings a few weeks from now, Dan.
Yeah, I mean, this is a big call as far as what they're seeing. They see potential upside to their fiscal 22 profit estimate based on gross margins, up 6 basis points here. Like that would be the sort of thing that you would get a re-rating for, I guess. The stock up 20-some% in just a couple months. It broke out to new highs. It was actually lagging some of the big box peers. We know that Target had already broken out. This one to me, again, like you mentioned, valuation is an issue here. This is a low single digits grower. Margin improvement would be reason to kind of support that valuation. I just don't know how the analyst community and the investor community could have it so wrong that we could be looking back, 6 to 8 weeks and this stock was just kind of, meandering, near its prior high. So I just don't buy stocks on calls like this,
no,
especially,
I get it.
you know what I mean? So to me, it's expensive. It's massively outperformed many of its peers now over the last 2-3 months. It's not for me.
No, and I understand that. And obviously, they're sort of they're putting their foot on the gas pedal here. They're basically banking on their past success in terms of their stock call, and they're sort of putting more money into the middle of the table, which I get. They're probably, Dan, they're probably going to be right as we head into earnings, because this is not only a growth story, it's also a recurring revenue story as well, which probably is one of the reasons they're deserving of that premium multiple. We'll see. Yeah. But that takes us to our next chart, Dan Nathan. Please, as they say, slide it, Earl, because this is one for the road. Great earnings expectations. I want to thank Mr. Butters, who's back, by the way. Great to have him back. I hope he enjoyed his vacation. Speak to this, Dan, because I look at this. I know what it says to me. I'm curious what it says to you.
Yeah, listen, he's just kind of showing us the data here. Analysts are tripping over themselves to raise, Q2 estimates as we kind of get into Q3 reporting period here. Listen, we just talked about it being behind the curve here, on Wall Street, the idea of getting too far out ahead of yourself and kind of being wrong when you're being too optimistic versus being too pessimistic. That's where you have career risk, right? Being too pessimistic. Mm-hmm. There's always an analyst who's going to take that baton from you and be a little bit more rosy here. So I love Butters' work here. This is really great to give us a sense of where expectations are heading into the end of the quarter as we get towards, Q3 earnings here. But here's the deal, guy. If I look at that Atlanta Fed GDP now and some of these other readings of kind of Q3 GDP, they're coming down here, right? And we're seeing really slow data out of China. There was some bad services data on the PMIs there. Who knows what's going on with Europe right now? I know that there's some talk about rates going higher, but here's the thing. We mentioned rates before. They're not going anywhere right now. So you tell me, are they suppressed right now for a whole host of technical reasons, or are they a greater read on what growth might be for the balance of the year? And analysts getting ahead of themselves with estimates, with raising expectations, is not a great setup when the S&P 500 hasn't had a meaningful correction in 200 days, right? And you think that valuations are getting a bit rich.
I love that John gave us this because it's fascinating. And you earlier mentioned, Dan, you said coming to a theater near you. Now watch what I do here. I'm going to wrap this whole thing together. What's not coming to a theater near you, unfortunately, at least for the foreseeable future, is Top Gun. Why do I mention Top Gun? Because if you recall, remember that scene where he says we were inverted and he did this thing? Yeah. Well, this arm here are the analysts. They're trying to catch up. This arm here going down, that's GDP growth. It's inverted. And then the guy said, bullshit. See, I didn't do it on live TV, but you know what I'm saying? Yeah. And that's exactly what's happening. Analysts are way behind the curve on this one. They're trying to catch up when they should be going the other way. This is going to be really interesting over the next couple months to see. These two have now crossed. We'll see who's right. My sense is, Dan, it's that GDP growth, which is probably not going to be as rosy as these analysts think it will be. Dan, see what I did there? I tied the whole thing together.
I do. Let's stay above that hard deck here, guy. 11 o'clock is that hard deck. Here's the deal, though, man.
Well, we're well below it or ahead of it. So whatever we are.
Here's the one thing I will just tell you. We could be heading into the danger zone if Q3 gets ahead of itself. Let's just say you just match these greater expectations, but then you see a downshift for Q4. A lot of stocks at these valuations are going to be trading off future expectations, not what just happened in the rearview mirror. So that's kind of my view right here. I don't love seeing expectations getting ratcheted up at valuations like this with complacency where it is, right? With the markets where they are. That's my final take there, guys.
And let's just summarize this thing. And by the way, I would watch Tom Cruise read The Phone Book. I think he's brilliant. And Val Kilmer, one of the most underrated actors of our time. Summary page, you can read for itself. Listen, what do I take from this? The fact that John Paulson's on one end of the screen, and then obviously Novo goes the other side of it. A lot of people, a lot of the old boomers, and I said old boomer is a bit of a redundancy. They're in the Paulson camp, but you know what? The world's changing beneath their feet. One for the road. We just did it. I think that's a really great job by Mr. Butters. He's coming back in a major way. Close us out, Dan, before I thank our sponsors.
Yeah, man. I mean, markets are just kind of tripping higher here. Expectations, keep an eye on that. I think the level of complacency is really important. And why do we talk about crypto on a show like this? Because it really does speak to the level of risk taking that you're seeing among lots of different market participants. So it's always interesting to keep an eye on where the money is flowing here. And right now, there is a full-on rage in NFTs, and a lot of people are explaining it away. Maybe Mr. Paulson was speaking to that and less about Bitcoin. But again, Guy, this was fun. Great summer doing at 1046 with you, my man. And we got a lot of exciting things coming for it in the fall.
Yeah, we do. Yeah, we do. And I'm sorry we went late. I apologize. Yeah. Your meeting is still going on. Don't worry about it. But today's episode has been brought to you by our presenting sponsors, FactSet, financial data and analytics powered by Tamar, and of course our friends at OpenExchange. Dan, you know what they do. They manage virtual meetings that matter for the top companies around the world. I will see you next Thursday at 1046. Say goodbye, Dan, Nathan, please.
See you all next week. And Guy and I will see you tonight on Fast Money. Tune in.